Thank you, Chairman, and Chairwoman, Chair Yellen. Thank you for being here today. You know, over the last few years, there's been a lot of discussion about a financial institution being systemically important. And Section 165 of the Dodd-Frank sets an arbitrary threshold of $50 billion. That designation then triggers enhanced prudential standards. Of course, as you and I have discussed, I'm not a big fan of the SIFI designation because I believe it is an implicit designation of an institution being too big to fail. And with that said, the $50 billion threshold that's currently in place, I don't think, in my estimation, and I think a lot of other people, it isn't really working because it places an undue burden on mid-sized banks that aren't systemic to meet additional enhanced standards. And so I want to applaud Congressman Luetkemeyer and Stivers for their leadership in this issue. As you know, this month the OFR, the Office of Financial Research, released a study examining, I think it's called Systemic Important Indicators. It looked at 5 factors: size, interconnectedness, substitutability, complexity, and cross-jurisdictional activity. This came out of the Basel Committee, as you're aware of. So does the Federal Reserve agree that these 5 factors that were used by the Basel Committee are the primary indicators of a financial institution's systemic importance?
We would certainly look at factors like that and take those into account in deciding on an institution's systemic importance. I mean, I completely agree that a $50 billion banking organization is very different in its systemic footprint than a $2 trillion organization. And Section 165 does allow the board to differentiate among companies based on their capital structure, their riskiness, their complexity. And we have done so in writing rules pertaining to the 165 standards. So there is flexibility, not total, but a good deal of flexibility to tailor our supervision and requirements to the systemic footprint of the firms, and the requirements on the $50 billion firms are not the same as the requirements on the more systemic institutions.
But basically, the parameters that you have only to let you determine what happens to people in the box. It does not let you determine who is and who isn't in the box. And when you look at that study, what you realize is one of the least of the companies that has been determined to be systemic. There's a huge range between the firms that are larger and not systemic. And so I think if you look at that chart, and I'm sure you've seen that, is we have a big gap there, and that big gap is problematic. And I think a lot of people think that, that we need to do better in that area. And so if you think these standards are acceptable, then would you be receptive to accepting a different arrangement where you use, standards that have been adopted by Basel, and if the Fed has additional standards that you would like to include in that, so that everybody would know whether they were in the box or out of the box?
I think trying to draw any line and having some firms just below and some firms just above creates an element of arbitrariness, and wherever that line is, one retains that problem. So it is important that the statutes enable us to differentiate and try to tailor rules to different firms of different complexities that are important. There are some things that we must apply to every firm over $50 billion, and the same would be true if that were changed.
The statute doesn't allow you now to draw that line. The line is drawn for you. And so do I hear you saying that you think that's a flawed process?
I'm saying wherever you draw the line, there will be a kind of arbitrariness that's associated with it. If you drew it at $200 billion, I'd still say that most $200 billion firms are different than the very largest financial institutions, and we would still want the flexibility to be able to impose different requirements on those firms.
Is that what you're saying?
I'm saying
No,
it's,
you said it was arbitrary, so should we not draw the line?
well, it's, Congress chose to draw a line and to apply enhanced standards to a certain class of firms. And what I'm saying is we absolutely recognize that within that large class of firms, they do differ in terms of their complexity and systemic footprint, and we need to tailor regulations that are appropriate and not identical for the largest and the ones that come closest to wherever that
The
dividing line is.
time of the gentleman has expired. The Chair now recognizes the gentleman from Massachusetts, Mr. Lynch.